There's something fascinating about market crashes. Every single time one happens, we hear the same refrain: nobody saw it coming. But here's the thing, that's not entirely true. There are always people who saw it coming. The real question is, why does everyone else miss the signs? Today, I want to talk to you about something that's been bothering me for a while. We're potentially sitting on the edge of another significant market correction, and I believe most investors are going to be completely blindsided by it. Not because the signs aren't there, but because of how our brains work, how the market has conditioned us over the past decade, and because of some fundamental shifts in market structure that most people simply don't understand. Let me take you on a journey through the psychology, the data, and the mechanisms that make the next crash so predictable, yet so likely to catch everyone off guard. The recency bias problem. Let's start with something called recency bias. It's one of the most powerful cognitive biases affecting investors, and it's working overtime right now. Think about this. If you started investing any time after 2009, your entire investing experience has been shaped by one of the longest bull markets in history. Sure, we had the COVID crash in March 2020, but that recovered so quickly that it barely registered as a real bear market in many investors' minds. It was more like a really bad month that fixed itself almost immediately. The S&P 500 has returned approximately 13 to 14% annually over the past 15 years. That's significantly higher than the historical average of around 10%. What this means is that an entire generation of investors has been conditioned to believe that dips are buying opportunities, that the market always comes back quickly, and that holding through volatility always pays off. But here's the uncomfortable truth. This isn't normal. The period from 1966 to 1982 saw essentially zero real returns in the stock market when adjusted for inflation. Japan's Nikkei peaked in 1989 and didn't reach those levels again until 2024. That's 35 years of waiting. The Nasdaq took 15 years to recover from its 2000 peak. Most investors today have never experienced a prolonged bear market. They've never sat through years of their portfolio declining or moving sideways. This creates a dangerous complacency. They think they know how they'll react when the market drops 40 or 50%, but knowing intellectually and experiencing emotionally are completely different things. The "this time it's different" syndrome. Now, whenever I bring up historical crashes, I always hear the same counter-argument, but this time it's different. And you know what? In some ways, it always is different. The specific triggers change, the specific sectors involved change, the specific economic conditions change, but the fundamental pattern remains remarkably consistent. Every major market crash in history has been preceded by a period where investors convinced themselves that old rules no longer applied. Before the 1929 crash, people believed that the Federal Reserve had learned to smooth out the business cycle. Before the dot-com crash, people believed that the internet had created a new economy where profitability didn't matter. Before the 2008 crash, people believed that housing prices could never decline nationally and that financial engineering had distributed risks so effectively that a systemic crisis was impossible. Today, what do we hear? We hear that AI will transform everything, that passive investing has changed market dynamics permanently, that the Federal Reserve will always step in to support markets, that there is no alternative, or TINA, to stocks given bond yields. I'm not saying AI isn't transformative, it probably is. I'm not saying the Fed won't try to support markets, they probably will. What I'm saying is that this confidence, this certainty that we figured it all out, this is exactly the mindset that precedes major crashes. The valuation picture. Let's talk about valuations, because this is where things get really interesting and where I think most investors are missing the forest for the trees. The cyclically adjusted price-to-earnings ratio, or CAPE ratio, developed by Nobel laureate Robert Shiller, currently sits at levels only exceeded by the 1929 peak in the dot-com bubble. As of late 2024, we're looking at CAPE ratios around 33 to 35, compared to a historical average of around 17. Now, I know what some of you are thinking. Valuations can stay high for a long time. They're a terrible timing indicator, and you're absolutely right. High valuations alone don't tell you when a crash will occur, but here's what they do tell you. They tell you about future returns. Historically, when the KPI ratio has been above 30, the subsequent 10-year returns have been significantly below average, often in the low single digits, or even negative in real terms. This isn't speculation, this is what the data shows us. But here's the problem. Most investors don't think in 10-year time horizons. They think in much shorter terms. They see the market up 20% this year and extrapolate that forward. They don't stop to consider that these high returns might be borrowing from future returns. There's another valuation metric that's even more concerning, the market cap to GDP ratio, sometimes called the Buffett indicator, because Warren Buffett has cited it as his favorite valuation metric. This ratio currently sits at approximately 170 to 180%. To put that in perspective, in 2000, at the peak of the dot-com bubble, it was around 140%. Before the 2008 crash, it was around 105%. The US stock market is currently valued at nearly twice the size of the entire US economy. Think about that for a moment. Does that seem sustainable to you? the concentration risk. Nobody's talking about. Here's something that should terrify you, but probably doesn't, because it's happened so gradually: the extreme concentration of the US stock market. As of late 2024, the top 7 stocks, what people call the Magnificent Seven, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, represent approximately 28 to 30% of the entire S&P 500's market capitalization. Let me repeat that. 7 companies out of 500 represent nearly a third of the index. This is unprecedented concentration. Even during the dot-com bubble, the top 7 stocks represented a smaller percentage of the index. And here's the kicker. Because of passive investing, which now represents over 50% of all US equity assets, money flows into these stocks automatically regardless of valuation, regardless of fundamentals, simply because they're the biggest. This creates a dangerous feedback loop. These stocks get bigger, so more money flows into them through index funds, which makes them bigger still, which means more money flows in. It's a momentum machine that works beautifully on the way up, but think about what happens when it reverses. When these stocks start to decline, index funds will sell them automatically during redemptions. There's no fundamental analysis happening, no value investor stepping in to say, this is a good price. It's just mechanical selling. And because these stocks are so large, their decline will drag down the entire index, which will trigger more redemptions, which will trigger more selling. We've created a market structure that's almost perfectly designed to amplify both rallies and crashes. And most investors have no idea this is how their index funds actually work. The liquidity illusion? Let's talk about something that financial professionals understand, but retail investors generally don't. Liquidity. When you look at your brokerage account and see that you have, let's say, $100,000 invested in stocks, you think you have $100,000. After all, you could sell tomorrow and get that money, right? Well, maybe. You individually could probably sell tomorrow. But what if everyone tries to sell at the same time? This is called the liquidity illusion. The price of any asset is determined by the last transaction. But that transaction usually involves a tiny fraction of the total outstanding shares. The market cap of a company is calculated by multiplying the price of that last transaction by all outstanding shares. But that doesn't mean you could actually sell all those shares at that price. Think of it like a crowded theater. In normal times, people exit in an orderly fashion. But when someone yells, "Fire!" everyone rushes for the exits at once. The doors that seemed perfectly adequate become a deadly bottleneck. During the March 2020 crash, we saw this play out in real time. The US Treasury market, traditionally the most liquid market in the world, essentially froze. Bid-ask spreads widened dramatically. Even US Treasury bonds, supposedly the safest and most liquid assets on Earth, were difficult to sell at reasonable prices. If that can happen in the Treasury market, what do you think happens in stocks during a real panic? High-frequency traders, who provide much of the liquidity during normal times, pull back or shut down entirely. Market makers widen their spreads. Suddenly, the market that seemed deep and liquid becomes shallow and dangerous. The rise of algorithmic trading and high-frequency trading has made this problem worse, not better. These algorithms are designed to make money in normal conditions, but they're programmed to shut down when volatility exceeds certain thresholds. So exactly when you need liquidity most, it evaporates. The leverage time bomb. Here's something that should keep you up at night. Leverage in the financial system. Margin debt, the amount of money borrowed to buy stocks, reached record levels in 2021 at over $900 billion. While it's declined somewhat since then, it remains historically elevated. But that's just the visible leverage. There's also invisible leverage in the form of options, derivatives, and structured products. The total notional value of derivatives globally is estimated at over $600 trillion. Now, notional value isn't the same as actual risk exposure, but even a small percentage of that number represents enormous potential for forced selling during a crisis. Then there's leverage in private equity and private credit markets. These markets have exploded over the past decade, growing from around $4 trillion in 2010 to over $13 trillion today. Much of this is financed with debt. When interest rates were near zero, this debt was cheap and easy to service. But with rates significantly higher now, many of these investments are struggling. Here's the dangerous part. Private equity and private credit are marked to model, not marked to market. That means their values are based on estimates and assumptions, not actual transaction prices. During a crisis, when these assets finally do trade, the realized prices are often dramatically lower than the modeled values suggested. This creates a wealth effect in reverse. People think they're wealthy based on these inflated private valuations. When the true values are revealed, they feel much poorer and cut spending accordingly, which accelerates the economic downturn. The psychology of capitulation. Let me paint you a picture of how the next crash will likely unfold psychologically, because understanding this might help you avoid the worst mistakes. Stage 1, denial. The market drops 5 or 10%. Most investors see this as a buying opportunity. Stocks are on sale, they think. They might even add to positions. The financial media talks about healthy corrections and shaking out weak hands. Stage 2, bargaining. The market drops another 10%. Now people start to feel uncomfortable, but they tell themselves stories. The Fed will cut rates. Earnings are still strong. This is temporary. They hold on, believing the recovery is just around the corner. Stage 3, fear. The market is down 30%. Now people are scared. They check their portfolios constantly. They can't sleep at night, but they still don't sell because selling would make the losses real. They're paralyzed by the gap between where they bought and where the market is now. Stage 4, capitulation. The market drops another 10 or 20%. This is when the real damage happens. After weeks or months of losses, investors finally break. They can't take the pain anymore. They sell everything, often near the bottom. This mass capitulation creates the final washout that usually marks the end of the crash. Stage 5, despair. After the crash, investors swear they'll never invest in stocks again. They've learned their lesson. Of course, this is exactly the wrong time to be out of the market, but emotionally they can't handle getting back in. The tragic thing is that we know this pattern. We've seen it play out over and over throughout history. Yet every time, the vast majority of investors go through all 5 stages, making the worst possible decisions at each point. Why? Because knowing intellectually how you should behave and actually behaving that way when your life savings is declining by thousands of dollars a day are completely different things. What makes this time potentially worse now? Let me explain why I think the next crash could be particularly severe and catch people especially off guard. First, we have an entire generation of investors who've never experienced a real bear market. The average age of investors has dropped significantly with the rise of apps like Robinhood and the meme stock phenomenon. These investors have only known markets that go up. They've been trained to buy every dip. When the dip doesn't stop dipping, the psychological shock will be profound. Second, the concentration of wealth and financial assets has never been higher. The ratio of financial assets to GDP has exploded over the past decade. More household wealth is tied up in stocks and real estate than ever before. When these assets decline, the wealth effect will be massive, leading to rapid cuts in consumer spending. Third, government debt levels are at peacetime records. The U.S. debt to GDP ratio is over 120%. This limits the government's ability to respond with massive fiscal stimulus like we saw in 2020. The political environment also makes coordinated fiscal response more difficult. Fourth, we're potentially facing a crisis that combines financial stress with real economic problems. The past few crashes, in 2000 and 2020, were primarily financial or health crises. The real economy was relatively healthy going into them. This time, we're seeing signs of real economic strain. Commercial real estate stress, regional banking system fragility, consumer credit deteriorating, corporate debt refinancing problems at much higher rates. When financial stress meets real economic weakness, crashes tend to be deeper and recovery takes much longer. The triggers. Nobody's watching. So what could actually trigger the next crash? Here are some candidates that I think aren't getting enough attention. The commercial real estate time bomb. Office buildings across America are worth far less than the mortgages secured by them. Banks, especially regional banks, have enormous exposure to commercial real estate. We've already seen cracks with the failures of Silicon Valley Bank and First Republic in 2023. The full scope of commercial real estate losses hasn't been recognized yet because banks are extending and pretending, refinancing loans rather than forcing sales. But this can only go on for so long. Private credit crisis. The private credit market has grown explosively, lending to companies that can't access traditional credit markets. Much of this debt will need to be refinanced at much higher rates. Default rates in private credit are likely to spike, causing losses for pension funds and endowments heavily invested in these strategies. Emerging market debt crisis. Many emerging market countries borrowed heavily in dollars when interest rates were low. Now, with the dollar strong and interest rates high, they're struggling to service this debt. A wave of sovereign defaults could ripple through the global financial system. Geopolitical shock. War, trade conflicts, or other geopolitical events could trigger a sudden risk-off move in markets. With valuations extended and leverage high, markets are vulnerable to any shock that makes investors want to reduce risk quickly. The thing about triggers is that they're almost impossible to predict. In 2007, most people hadn't heard of subprime mortgages. In early 2020, a virus in a Chinese city seemed like a distant concern. The actual trigger often comes from left field. What matters more than identifying the specific trigger is understanding the vulnerabilities in the system, what you can actually do about it. So after all this doom and gloom, what should you actually do? First, and most importantly, understand that I'm not telling you to sell everything and hide in cash. Market timing is incredibly difficult, and I don't pretend to know when the next crash will occur. It could be next month, next year, or several years from now. Valuations can remain extended for long periods. What I am saying is that you should be prepared, both financially and psychologically. Financial preparation means stress testing your portfolio. If your portfolio dropped 50% tomorrow, would you be okay? Do you have enough cash reserves to weather job loss or income disruption? Are you overconcentrated in a few stocks or sectors? Do you understand how much risk you're actually taking? Many investors think they're diversified because they own an S&P 500 index fund. But remember what we discussed about concentration. You're heavily exposed to 7 companies. Consider true diversification: international stocks, different market cap ranges, different sectors, even alternative assets like commodities or real estate. Psychological preparation might be even more important. Really imagine, your portfolio dropping 40%. How would you feel? What would you do? Having a plan before the crisis hits is crucial. Write it down. Tell someone else about it. This makes it more likely you'll follow through when emotions are running high. Consider your time horizon. If you're 25 years old and investing for retirement, a market crash is actually an opportunity. You'll be buying at lower prices for years. But if you're 60 and planning to retire in a few years, a major crash could derail your plans. Your asset allocation should reflect your time horizon and your ability to handle volatility. Think about dollar cost averaging out of positions. If you're heavily concentrated in stocks that have run up dramatically, consider gradually taking some profits over time. You might miss some upside, but you'll also reduce your risk. Most importantly, educate yourself about market history. Read about past crashes. Understand that markets are cyclical. Understand that bear markets are a normal part of investing, not a failure of the system. The more you understand about how markets work, the less likely you are to panic when things get rough. The bigger picture. Here's something I want you to understand. Market crashes, while painful, are not the end of the world. In fact, they're a necessary part of how capitalism works. They clear out excess, they force reallocation of resources, they reset valuations to more sustainable levels. Every major crash in history has eventually been followed by recovery and new highs. The U.S. stock market has survived the Great Depression, World War II, the 1970s stagflation, the dot-com crash, the 2008 financial crisis, and COVID. It will survive whatever comes next. The question is not whether markets will recover, it's whether you will be positioned to benefit from that recovery. And that depends entirely on how you prepare for and react to the crash itself. The investors who do well through market crashes aren't the ones who predict them perfectly. They're the ones who maintain perspective, who stick to their plan, who have the financial and emotional resources to buy when others are selling in panic. So why will the next market crash catch most investors off guard? Because of recency bias that makes them believe bull markets last forever. Because of extreme valuations that they've learned to ignore. Because of market concentration they don't understand. Because of leverage they can't see. Because of liquidity that will disappear when they need it most. And because of psychology that hasn't been tested in over a decade. The signs are there, the vulnerabilities are real. The questions are simply when and how severe. My goal today wasn't to scare you, though I realize some of what I've said might be unsettling. My goal was to help you prepare, to make you think critically about your investments, to encourage you to be honest with yourself about your risk tolerance and your time horizon. The best time to prepare for a crash is before it happens. During the crash, your emotional brain takes over and rational planning becomes nearly impossible. That's why we're having this conversation now, while markets are still relatively calm, while you still have time to think clearly and make thoughtful decisions. Remember, the goal of investing isn't to get rich quick. It's to build wealth steadily over time, protecting what you've gained while continuing to grow. Sometimes the best offense is a good defense. So take some time this week to really look at your portfolio, stress test it, have honest conversations with yourself and with your family about your financial goals and your risk tolerance. Make a plan for how you'll respond if markets drop significantly, and then stick to that plan. Because when the next crash comes, and it will come eventually, you'll be one of the few who isn't caught completely off guard. You'll be prepared, you'll have perspective, and that will make all the difference. Thank you for watching. Stay informed, stay prepared, and remember, the best investment you can make is in your own financial education.